On the darker side is Direxion indexed managed futures DXMIX, which has posted a 3.15% average annual loss on its institutional shares in the same 5-year period. The fund has lost 20.03% this year. It too is largely a mix of cash and bonds, with a 24.5% injection of rocket fuel managed futures. Unfortunately, the fund's rocket fuel has more closely resembled the kind used in early North Korean ICBM tests. The Direxion offering follows the Auspice Managed Futures Index, a long-short index that provides exposure to 21 futures markets including commodities, currencies and interest rates. As of June 30, the fund was largely been betting against the dollar good and against energy bad. Why invest in commodities at all? A 1983 paper by the late Harvard professor John Lindner, The Potential Role of Managed Commodity Financial Futures Accounts and/or Funds in Portfolios of Stocks and Bonds, showed that managed futures had substantial diversification benefits for stock portfolios. This makes sense. Managed futures funds can bet on rising or falling prices and have a low correlation with stocks or bonds. And limited data shows that Lindner's findings have merit. Guggenheim Managed Futures Strategy ARYMFX, the oldest open-end managed futures fund, gained an annualized 12.4% during the 20,072,009 bear market, versus an annualized loss of 42.95% for the Standard & Poor's 500 stock index, and a 48.26% for the MSCI Europe, Australasia and Far East index. If you are worried about a stock market downturn, then a managed futures fund might make sense, especially since the funds have had such a wretched performance recently. Steve & Company, which specializes in alternative investments, including managed futures, just published a white paper arguing that periods of really rotten performance from managed futures often leads to relatively short bursts of outperformance, in other words, reversion to the mean. While clearly from a self-interested source, the Steve paper raises some interesting points. The first is that performance for managed futures has been unusually awful, particularly when looked at in terms of their Sharpe ratios, which measures return in relation to risk. The Barclays CTA index, which represents the equally weighted average net returns of a large set of managed futures programs, had a 12-month Sharpe ratio of 1.99% in the 12 months ended June 30, its worst 12-month period ever. The paper, co-written by John Dolphin, Steven's chief investment officer, and Christopher Maxey, a senior portfolio manager for the firm, notes that those Sharpe ratios tend to revert to the mean. If the mean reversion pattern continues, this indicator could bode well for managed futures. The consistent result across our tests is that there does appear to be historical mean reversion in managed futures Sharpe ratios, with weaker 12-month periods being followed by stronger 12-month periods, and vice versa, the authors wrote. This result would justify a strategy of buying the dips in managed futures and moderating positions after a strong period of performance. Of note, managed futures outperformance tends to be in short, sharp bursts. Waiting for a confirmation of the uptrend can mean you'd miss a significant portion, up to 40%, of positive returns. Since the bulk of returns in managed futures were concentrated in relatively short windows of time, a return-chasing approach such as this can miss the early returns in a run-up and may incur a large opportunity cost, the authors say. Most entrants to the managed futures arena are fairly new. There are only 3 ETF offerings, and the oldest one, Wisdom Tree Managed Futures Strategy ETF WDTI, made its debut in January 2011. The fund has lost 0.93% a year the past 5 years. They are also fairly expensive. The $11.9 billion Aqua Managed Futures Strategy I, for example, charges 1.20% in expenses, which is cheap for a managed futures fund, but still on the high side of the institutional mutual fund universe. The Superfund Managed Futures Strategy A Fund, the top-performing futures fund this year with a 10.78% gain, charges 3.24% in expenses in addition to a 5.75% front-end commission. The takeaway: it's good to buy low, but, as star manager Peter Lynch was fond of saying, it's always darkest just before it's pitch black. Advisors who want to use managed futures should tread carefully and make sure they're not paying too much for what they buy.